Every empire loves to tell itself a story. The story is about glory, flags, and destiny. It's about explorers tracing rivers on maps, speeches in parliaments, and lines drawn in ink across continents. It's about civilization, progress, and national honor. But if you strip away the poetry and look underneath, you find something far more familiar and far more brutal. You find a balance sheet. Between 1880 and 1914, a handful of relatively small European countries carved up almost an entire continent. Britain, France, Belgium, Germany, Portugal, Italy, Spain. On the surface, it looks like a geopolitical land grab, a race for prestige and colored patches on the map. But behind every flag planted in African soil, there was a ledger in European ink. Someone financed it, someone insured it, someone expected a return. The scramble for Africa wasn't just a race for land, it was an accounting project. Welcome to Empire Ledger, where money, power, and history collide, and nothing is ever as simple as it looks. The scramble for Africa is usually told as a story of rival empires, heroic explorers, and diplomatic conferences. But if you follow the money instead of the myths, a different pattern appears. You start to see that empires didn't just conquer territory, they acquired assets. They didn't just civilize populations, they captured cash flows. And the civilizing mission that politicians talked about in London, Paris, and Brussels. On the books, it looked a lot more like a high-risk, high-return investment strategy. Empire wasn't just painted on maps. It was recorded in balance sheets. To understand how we ended up with a continent sliced into artificial borders, still living under the shadow of decisions made in European boardrooms, you have to go back to the moment when Africa stopped being a blank space to European bankers and became a portfolio. In the 1870s, if you looked at a European schoolroom map of Africa, most of the interior was still colored in with that famous phrase, unknown. On paper, the Ottoman Empire controlled parts of the north, a few coastal enclaves belonged to European powers, and much of the rest was a mosaic of African kingdoms, empires, and trading networks that had been there for centuries. But in London, Paris, and Berlin, the maps looked very different. In the financial districts, you didn't draw maps of land, you drew maps of risk and return. Europe was industrializing at a breakneck pace. Factories were hungry, copper for wires, rubber for machines, palm oil for industry, cotton for mills, gold for reserves. Investors, burned by the crash of 1873 and stuck in a long depression, were desperate for yield. Capital piled up in bank vaults and on the books of insurance companies with nowhere safe and profitable enough to go. So bankers and politicians looked outward. To them, Africa wasn't unknown at all. It was a spreadsheet of potential entries. Rubber meant projected revenues. Copper meant future export earnings. Labor became cost of extraction, preferably as low as possible. Railways and ports were capital expenditures that could be financed with bonds and repaid, they hoped, through customs duties and export taxes. In this worldview, a river was not just a river, it was a transport corridor. A forest was a future commodities line. A human being was a labor input. Empire, in this language, was less about glory and more about making the numbers work. In 1884 and 1885, European powers met in Berlin to decide Africa's future. The classic image is familiar. Diplomats in uniforms and frock coats around a big table, maps spread out, lines drawn with rulers. It's usually described as a diplomatic conference, a moment of high politics. In financial terms, it looked a lot like a mergers and acquisitions summit for an entire continent. Each empire came to the table with its own balance sheet problems. Britain needed new markets and secure routes to India, the jewel of its imperial portfolio. France wanted prestige, distraction, and economic recovery after humiliation in the Franco-Prussian War. Belgium, a small country with a king and a large ego, wanted a way to turn personal ambition into national assets. Germany was newly unified, industrially powerful, but late to colonies and anxious not to be locked out. The language spoken aloud was about free trade, civilization, and stability. The language behind the scenes was colder. It was about who would control which customs revenues, who would get access to which river systems, who would secure which mining rights, which harbors, which potential railway corridors. When you draw a line along a river, you are deciding who can tax the trade that moves along it. When you grant someone a coastal strip, you are giving them the future profits of a port. Lines on maps became lines in ledgers. From Berlin onward, Africa wasn't just a place, it was an investment thesis. But there was a problem. Conquest is expensive. Soldiers cost money, ships cost money, colonial administrators cost money. Voters back home didn't always enjoy paying higher taxes for distant adventures. So European governments reached for a familiar financial trick, one they had been using since at least the era of the East India Company. They outsourced the risk, they created or chartered private companies, and gave them extraordinary powers, monopolies over trade in certain regions, rights to collect taxes, rights to acquire land, even the right to raise their own police or armies. These entities were not normal businesses. They were hybrids, part corporation, part state, with shareholders at home and subjects abroad. The pattern went like this. A company is granted the right to exploit resources in a territory. In exchange, it promises to develop the land, build infrastructure, and bring civilization. Investors back the company, buying shares or bonds, betting on future profits from rubber, minerals, or cash crops. The company, under pressure to hit its targets and pay dividends, uses whatever methods it can get away with. Forced labor, taxation, monopolies, violence. If the scheme fails, the company collapses, and the losses are spread among investors and sometimes quietly socialized through state support. If it succeeds, they profit, and the state steps in later to formalize control. Risk privatized, power socialized. The Congo Free State is the most infamous example. On paper, it was the humanitarian project of Belgium's King Leopold II, a venture to end the slave trade, bring Christianity, and introduce modernity to Central Africa. On Leopold's private ledger, it was something else entirely, a rubber and ivory extraction machine. Look at it as a balance sheet. Under assets, millions of hectares of forest, river systems, and a population that could be forced to work. Under revenues, rubber exports at a time when the global demand for tires and industrial rubber was exploding. Ivory sales in European markets. Under costs, mercenary forces, administrators, shipping expenses, bribes and propaganda to keep foreign critics quiet. Under externalized costs, the ones that never appeared on the page, millions of African lives shattered, villages burned, families mutilated or murdered, a demographic catastrophe. Those last entries did not appear in the annual reports. They were never meant to. The logic extended across the continent. In southern Africa, companies like the British South Africa Company obtained huge concessions to exploit minerals and land, in exchange for vague promises of development. In West Africa, French administrators built a system where colonial budgets were supposed to pay for themselves through taxes, forced labor, and exports. Railways, customs houses, and military posts became both physical and financial infrastructure, designed to channel value in one direction, outward. Empire was not just about taking resources out. It was about pulling people into a financial system they had not chosen. Most African societies operated on a mix of subsistence farming, local markets, long-distance trade, and systems of credit and obligation that didn't revolve around European-style cash. For imperial accountants, this was a problem. You cannot easily tax a harvest that never touches a formal market. You cannot levy money taxes on people who do not use money. So colonizers changed the rules. They introduced hut taxes and poll taxes, fixed cash payments that every household or adult male had to pay each year simply for existing on the land their ancestors had lived on for generations. It was a neat bureaucratic trick. First, you declare that all land ultimately belongs to the colonial state. Then you graciously allow the original inhabitants to remain on the condition that they pay you for the privilege. To earn the cash they now owe, they have to work in your mines, on your plantations, or for your merchants. Taxation became a recruitment tool for cheap labor. The financial obligation forced people out of traditional livelihoods and into the cash economy on terms they did not control. Railways played a similar double role. In imperial propaganda, the iron tracks slicing across the landscape were symbols of progress, bringing civilization and modernity to the interior. On the balance sheet, they were extraction corridors. The lines conveniently ran from mines to ports, from plantations to ports, from inland collection points to ports. Raw materials flowed out, manufactured goods flowed in, profits flowed back to European shareholders. The cost of building and maintaining this infrastructure, the interest on railway bonds, the salaries of engineers and administrators, was often charged not to the imperial center, but to the colonies themselves. The colony became a business unit expected to pay for its own conquest. If you read the financial reports of colonial companies and administrations from the time, you see familiar language. Revenues improved, exports increased, budget deficits reduced. Infrastructure investment enhanced productivity. What you don't see is the human cost behind those tidy numbers. When rubber quotas were set impossibly high in the Congo, it did not appear in the books as increased worker mortality. It appeared as higher output per district. When famine swept through regions where farmers had been pushed to grow cash crops instead of food, it was described as a temporary disruption, a shortfall in native production. When thousands died building railways under brutal conditions, their deaths were not a line item. The railway appeared as an asset. The graves did not. In a normal business, at least in theory, you pretend that customers and workers are stakeholders whose welfare matters. In the balance sheets of empire, African lives were closer to raw material, necessary inputs, expendable, replaceable. The result was reports that looked successful from the vantage point of the metropole. Exports were climbing, budgets were balanced, colonial debts were serviced, dividends were paid. Politicians could point to profitable colonies as proof that empire was worth the cost. On the other side of that ledger, the side that did not get printed, you had forced labor, displacement, famine, repression, and demographic collapse, the hidden losses that propped up the visible gains. Even by their own standards, many colonial ventures were financially shaky. Railways went over budget. Companies collapsed under corruption and mismanagement. Administrations cost more than they generated. Rebellions and resistance movements demanded expensive military campaigns. You might expect European taxpayers to ask a simple question: why are we paying for this? The answer was another familiar financial maneuver, one still used today: creative presentation. Losses were spread out over long-term national debt, hidden within larger budgets, or justified as strategic necessities. Deficits could be rolled over. Interest could be refinanced. Military spending in colonies became part of the general defense bill, and the burden of empire was diluted, disguised, and deferred. And the story told to the public was never the story of cash flows. It was the story of duty, prestige, security, and destiny. You weren't paying for a risky overseas investment. You were paying for the greatness of the nation, for your country's rightful place in the world, for the mission to civilize supposedly backward peoples. It is the same trick modern governments use with financial systems. Wrap material interests in moral rhetoric, turn extraction into virtue. That's not conspiracy, it's policy. By the mid-20th century, the formal empires began to crack. War, resistance, and changing global politics made the colonial model unsustainable. One by one, African nations fought for and won independence. Flags changed. Anthems changed. Constitutions changed. But balance sheets are stubborn things. Many new states inherited debts run up by colonial administrations, money borrowed in their name to build railways and ports, designed primarily to move resources out, not to connect local economies. They inherited export structures built around a handful of commodities, leaving them at the mercy of prices set in London or New York. They inherited currencies tied to or influenced by former colonial powers, legal systems that prioritized property rights and contracts written decades earlier, and long-term concessions granted to foreign companies. In theory, political sovereignty should have meant a clean slate. In practice, the old ledger lines continued into the new era under different headings. Control of resources moved from colonial governments to multinational corporations. Formal empire gave way to foreign investment, development loans, and aid packages with conditions attached. The logic remained recognizable. Assets in Africa, profits elsewhere. Risk in Africa, security elsewhere. When newly independent countries tried to break that pattern by nationalizing resources, renegotiating concessions, or restructuring debts, they often discovered that the frontier had shifted. The gunboats were less visible, but another set of gatekeepers stood between them and economic autonomy: creditors, international financial institutions, and global markets. A country that defied bondholders or major lenders could find itself cut off from credit, punished in currency markets, or subjected to political pressure or dressed up as concern for stability. The scramble for Africa never really ended. It just moved from territory to terms and conditions. So what survives when the speeches fade and the empires fall? Maps can change in a day, borders can be redrawn, flags can be lowered and burned, statues can be toppled or removed in the middle of the night. But contracts last. Debt lasts. Infrastructure laid down to serve one purpose doesn't simply turn itself around when the flag changes. If you reduce the scramble for Africa to a simple story of Europeans bad, Africans victimized, you miss something crucial. You miss how financial logic shaped decisions that still ripple outward. Empire was absolutely shot through with racism and hierarchy. That was the constant justification. But underneath the ideology, there was a spreadsheet. That's why borders were drawn to secure resources and routes, not to reflect human realities on the ground. That's why railways in many regions ran from mines to ports instead of between African cities. That's why legal systems were designed to protect contracts and concessions first, lives and communities second. The structure was not accidental. It was optimized for extraction. Once you see that, you also start to see why so many African economies, decades after independence, still struggle with patterns that look suspiciously familiar. Exporting raw materials, importing finished goods, borrowing in foreign currencies, living with the constant threat that a price swing in a commodity they don't control will blow a hole in their budget. The numbers on a balance sheet written in 1890 can echo in a national budget in the 21st century, not because of fate, because of design. So what should you take away from the scramble for Africa if you view it not as a morality tale, but as a financial one? First, follow the money, not the speeches. Whenever you hear phrases like civilizing mission, development, security, or stability, ask yourself who pays, who profits, and who bears the risk. The answer is almost never spread evenly. Second, remember that balance sheets are political documents. What you choose to count as a cost or a benefit determines the story you tell. Colonial accountants wrote reports that made empires look profitable because they omitted the most important costs. Modern systems do something similar when they treat environmental destruction, social collapse, or human misery as externalities instead of liabilities. Third, understand that the end of formal empire doesn't automatically mean the end of extraction. Flags can change faster than financial structures. Debt contracts, ownership patterns, and trade rules can carry empire forward long after the governors have gone home. The scramble for Africa wasn't just a scramble for land. It was a scramble for revenue streams, assets, and control over future flows of wealth. If you only study the maps, you'll miss that. If you study the balance sheets, you won't. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.